The ultra wealthy don't just earn differently, they think differently about money. They run their finances like an institution, optimizing for legacy and tax efficiency over decades, not quarters. In today's episode of Wealth on the Move, the podcast, I interview Mark Miller, managing director of the Hilton family offices. Yes, that Hilton, and CEO of Hilton Tax Wealth Advisors, where we talk about pulling back the curtain on the mindset as it translates into moves any serious wealth builder can start making now. Make sure you check out this episode of Wealth on the Move, the podcast. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today we have a really special guest, somebody that has watched a family that is an American dynasty build, protect, grow, and plan to distribute their wealth. Today we have joining us Mark Miller. He is the managing director of Hilton Family Office. When I say Hilton Family Office, yes, I mean those Hiltons. He's also the president and CEO of Hilton Tax and Wealth Advisors. Mark, welcome to Wealth on the Move, the podcast.
Well, thanks so much. Thanks for having me, Will. Appreciate being here.
I'm excited to talk to you because when you think about the Hiltons, they're one of those families in the United States that have done what I hope that we all set out to do. They set out to build, they set out to create and earn, and then build generational wealth and create a legacy that lives well beyond the first hotel that they decided to build. So I'm excited to talk to you a little bit and try to get into the mindset of somebody building that wealth and of a family when it comes to those distributions. But before we get too deep into that, give us a little bit of history about Mark Miller, what your industry past is like and how you came to work with the Hilton family.
So I cut my teeth originally out of college, and I hate to admit it, it was in the mid 90s that I graduated from college a long time ago, but I cut my teeth with that small little company called American Express.
Okay.
And learned how to be a broker, built a lot of really good relationships, a lot of good clients, kind of what we call on the retail side of the business. I later started my own firm, still kind of on the retail side of the business. And then fortunately, I started meeting a lot of people that are what we call on the smart side of the business or the institutional side.
Yes.
A lot of clients that had a lot of wealth that did a work with a lot of trust companies. And then along the way, met the Hiltons many years ago. And not that many years ago, they just decided to ask me to be the managing director of the Hilton family office, which I am today. We also have a spinoff company called Hilton Tax and Wealth Advisors. That is Brad Hilton, who is the grandson of Conrad Hilton, is one of my main partners. And Brad and I had a passion for how can we bring some of these family office strategies a little more down to Main Street, folks that have maybe 500,000 million, 5 million. They don't have to have 20 or 30 million to become members of the of our family office. How can we give them access and bring strategies more down to their level? And that's where Hilton Tax and Wealth Advisors came from. So that's my kind of short history, but had a lot of years, decades in the business and have seen it and just realized now, when I started about halfway through my career, realizing that it's that the smart money does it a lot better than they do it on the retail side.
Okay. Why so? Why do you think that is?
Well, first of all, there's a few benefits of being kind of on the smart money side. Number one, very little fees are paid because if you look on the retail side, it's kind of funny when you talk to people, they think, oh, hey, Vanguard has only charged me 0.5% or Fidelity, 0.75%. And they're thinking, hey, they're not really charging me that much. Well, then I say, hey, if you look at, from a common sense standpoint, how do you think Fidelity or Vanguard has built those high-rise buildings in Manhattan?
Right.
They haven't done it on your 0.5%. A lot of people don't know, but they're paying a lot more than 0.5% in their mutual fund because on the retail side, there's a lot of things that are built in that happened many, many decades ago where Wall Street was, scratching the back of the government. The government was scratching their back. The average mutual fund makes anywhere from 3 to 4%. per year, both in internal and external fees, and they don't even know that. The reason I
Right.
bring that up is because retail investors mainly invest in mutual funds. So on the smart money side, those fees really don't exist, and it's not that issuers and market makers aren't making money. It's just that what they basically say is, hey, figure that into the deal. You pay yourself how you need to pay yourself. I don't want to pay those extra fees, those external fees, so to
Right.
speak. The other thing too is on the smart money side, the portfolios tend to be a lot less volatile because there's a lot more emphasis on safety. Plus, they have access to private equity, alternative investments that can make up, so to speak, for that safety and security by making outstanding returns on the equity side. So overall, it's just a lot better way. And that's why they say the rich get richer. Well, a lot of it's because the smart money folks have just better structured portfolios, help them sleep better at night than on the
Right.
retail side, and just do tend to do better long term.
Well, and I know it's easy to say this, especially about a family like the Hiltons or families similar to the Hiltons, but they have a much longer term mindset,
Yes.
and that seems to be, we're all familiar with the market's history and the ups and downs of the market, and they seem to be able to weather that, not because their stomachs don't hurt like ours do when the market's down, not because they're happy to see a loss in a portfolio, but they have a longer term mindset than what happened in just this quarter or this year or even, this, I tend to think that presidential cycles have such a, and I don't want to get into a political conversation at all, but, you know, even beyond a presidential cycle, they have a mindset where they're thinking in decades rather than quarters.
Yes.
And
Or
and I
years.
don't know, or
Yeah.
right, a year's not a long
3 or
time for
4
this.
years or 5 years.
Right,
That's really funny you say that, Will, because if you think about it on the retail side, and most people that are listening to this day today, even if you've got $10 million, $15 million, you're most likely still on the retail side
right.
where and I just did in my podcast, I just did a podcast on the levels of wealth. And that first million, that's really hard to get to, but then once you get beyond that, you're maybe to 10 million or whatever, or 5 million or 3 million, but you're still really only have available to you because you don't have access to the best of the best in that the world
Right.
has access to. But the Wall Street has done a brilliant job over the years of of attaching the retail investor to returns.
Yes.
So I hate to keep picking on mutual funds, but how do mutual funds sell themselves? The one, three,
Historical
five, 10 year
performance, right.
performance. There are still, I see people every day that come into our office, and we talk with them. And how did you pick that mutual fund? Well, I looked at their track record and they had a great 1, 3, 5, 10 year performance. I figured, hey, that I like that mutual fund, right? Looks like it's
Right.
pretty consistent, right? Well, the smart money folks, and let me give some advice here. If you focus more on safety and security and less volatility, then it's going to be easier to have a longer term mindset than if you just focus on returns.
Sure.
Okay. So I really want people to try to internalize that. And that's what the wealthiest of the wealthy do. So when you're not sitting there chasing returns and trying to find the quote best
Right.
investment, you're focused more on having portfolios that have a little bit smoother ride over time. If you have a
Right.
smoother ride, then you get better returns over time. You usually can eat 1 or 2 or sometimes even 3% per year, more per year out of your portfolio. So you bring up
Yeah.
a great point, and that is a huge, huge factor. If you can make that shift from thinking from short-term thinking to longer-term thinking, you're going to be closer to how the smart money thinks.
Yes. Well, and we're gonna watch this mayhem unfold here in the next few months with something like the SpaceX IPO. Everybody wants to get their hands on this, and, what I'm about to say isn't a recommendation or a condemnation of the company. I mean, it's going to be one of those life changing companies
Sure.
when dust settles and we look back in history. But this IPO is going to be one of the most popular in the history of the world, and it's going to be very, I don't know if disruptive is the word, but it's going to be very disorganized at the onset because everybody wants a piece of this
Sure.
because they want that giant return rather than owning a piece of a quality company that is admittedly going to be changing the world.
Yeah. And here's something to think about. Okay. So SpaceX is coming out with an IPO.
Mhm.
OpenIA is
That's
going to be
open,
coming out.
yeah, OpenAI.
Yeah, they're going to be coming out with an IPO, probably most likely the two biggest IPOs in history. So you also have to think most likely that's at the top of the market. Okay.
Right.
So, first of all, the smart money folks are very cautious of IPOs, especially if they're doing any portion of it on the retail side,
Mhm.
um, because IPOs tend to peak. They'll come out, especially if they're super popular, they'll peak, they'll explode. And then, speaking of this, a lot of the smart money get in there and then they dump shares and then they
Right.
drop down and then the dust starts to settle and you see what happens. I was just talking with a client about this when Coinbase came out, when crypto was going nuts
It's
and
so funny
Coinbase.
you mentioned that, yeah. That's
Yeah.
been the analogy that I've made here is,
Yes.
gr
Yes.
big company changing the world, necessary,
Yes.
but that thing IPO'd and doubled in price, and it hasn't been back there since.
Yes, absolutely. So, what I always tell people, it's probably not the best thing to initially invest in an IPO. Now, I could be wrong with
Sure, we all
SpaceX. Okay. Yeah. But most likely it's going to take the path of every other IPO. You also layer into it the fact that we're most likely at the top of the markets. The markets are getting, if they're not really close, they're getting closer and closer to massively shifting. By the way, we've had a run up for much longer than normal, a normal
Sure.
period of time. So, most likely, we're going to see, and it's just the nature of the markets, the harder it runs, the harder it falls.
Right.
So you have to be careful about that too. The smart money, well, I'll say most of the smart money folks have been in pre IPO, which has been available in SpaceX through various markets, very select and narrow
Sure.
markets. Uh, but then they'll come in, the smart money will come in and they'll take advantage and in essence, sometimes manipulate. They'll even help push it up so then they can make money on the side when it drops massively. So that's just one of the strategies that the smart money has done for years to come in and manipulate the retail markets.
Yeah. Well, but back to the initial point is and I have it open in front of me. I usually like to have our guests' books behind me, but I wanna thumb through it as we go. Mark wrote a book called Hilton Wealth: How to Invest Like an American Dynasty.
Right.
And that opening chapter is the smart money advantage is that long-term mindset.
Mm-hmm.
That's the biggest advantage. And again, my opinion is that we are still so very early on in most people needing to use the market. When we look back in the course of history, for the longest period of time, folks' retirements, while they were tied to the stock market, it wasn't up to them or it
Mm-hmm.
wasn't up to advisors.
Mm-hmm.
They had a pension, they had Social Security, and maybe a couple shares of a stock that they got from the grandparents or decided to buy their own shares one or two times. But everybody wasn't using the market all the time to fund their retirement, like what started the shift when 401ks replaced pension plans. So I'm of the opinion that this long term muscle that needs to be built by American investors still hasn't developed in a way that it needs to. Hopefully,
Yes.
it starts to develop, but having to use the market to fund your own retirement is still a relatively new concept in the United States. We're 1987 is that's about when the 401k laws took place. So
Yeah.
yeah, it's 40 years, but we're still getting through the first generation of folks
Mm-hmm.
funding their own retirement fully.
Yeah.
So
That's right.
I'm hopeful that this long term muscle that's necessary is going to start being developed. Now, we know that the media doesn't want us to develop that muscle because then fewer people watch the stock market on 3 or 4 different channels every day, and they don't watch the news and their emotions aren't tied to it. But
Mhm.
I'm hopeful that this longer term muscle starts to develop a little bit more
Yeah,
as we
I am
progress.
too. Yeah, I am too. And here's the great thing about this. And we know this only because we have so many great resources and so many great partners. We're understanding, and people need to understand that this is the greatest time, not in American history, but probably world history to be investing. You
Okay.
touched upon part of the shift because it's starting to become more of a, first of all, building wealth is a personal reliance thing. Okay.
Yes.
When you go back and you look at like the pension system and the 9 to 5 jobs, all of that, that was designed by the people in the upper echelon. Let's
Right.
call it the smart money people to create worker bees. Okay.
Right.
I mean, all there was to it. So because we had the industrial revolution, that's what they needed. That's what the system needed to run all do all the manufacturing, run all the jobs, all of that. The world is shifting and the world is changing to having more independence
Yes.
in building your wealth and growing your wealth. The 401k is kind of a bridge, you might say.
Sure.
It was still somewhat reliant on because we're using a government run system in a sense. We're
Right.
using that as a government umbrella, so to speak. But we all need to start thinking about that this truly is our responsibility. Where obviously, really, if you have any kind of money or decent money, Social Security is nothing. Social
Right.
Security is not going to give you much of. I've got a few family members that are, unfortunately, have had to rely on Social Security, and especially with, and let's talk about the real rate of inflation with things going up 8 to 10% per year, and
Right.
in and Social Security benefits going up 3. It is massively lagged behind, so they can barely support themselves and barely pay
Right.
for any on Social Security benefits. So all of that is really out the window and gone. So it's up to us to now build our wealth. And that's what we do is kind of teach people. We kind of teach people a better way. We think a faster way to build wealth and how the smart money does it. And how, as opposed to that more retail, long-term grind
Right.
that produces, and there's even to where I just found some statistics even with the baby boomers and how wealthy the baby boomers were, the wealthiest generation in history, that there's still the average baby boomer is retiring on $200,000.
Right.
That is insane. That
Yeah.
just is
It's a
shocking to
scary
me.
proposition. You're right.
Yeah, yeah. And and half of the baby boomers barely even have that.
Right.
So it's like, oh my gosh. And I think that's because of the system. In many ways, that old system was broke to truly build solid wealth, especially keeping up with, the massive inflationary environment we've really been in probably since, the 1970s when we went up the gold
Yeah.
standard. So anyway, no, I mean, you bring up some awesome points, and I mean, we're talking deep stuff now, but the
Right.
reality is, I think everyone has to realize they need to take responsibility. And even people are listening to this and they've already retired or they're getting really close to retirement. You know what? The good news is had still have a lot of medical breakthroughs and things like that, to where you're probably going to still live a long life,
Right.
uh, and
Well,
you
that
can
that and
still,
that's the other thing, that
yeah,
transition from pension to 401k was also when the world was shifting from longevity being a risk. That's kind of the bizarre
yes,
way to think about that. We'd all love to live long, healthy lives, but
yeah.
it's a risk to our money right now that we were not thinking of, that pensions didn't have to, you were hoping to be retired 10 years. And now that folks are retiring younger, living longer, and they have to have that long-term mindset. And I know I keep harping on this, but that long-term mindset it's probably the hardest thing and you may agree with this, hardest
I
thing
do
for
agree
us
with
as
that.
advisors to instill with our clients because, we know the market will drop by 20%. It's going to happen again. It's happened before. We can't see that coming. We don't know when that's going to happen. We never
Right.
know when the end of it is. So you don't want to make a transition, and trying to get that long-term mindset across to your clients, especially then is so incredibly difficult because there's no words that soothe their
Yeah.
anxiety when the market's doing that.
Yeah.
And trying to get that across. I guess being somebody that's sitting in the room with a family like the Hiltons when they're making decisions. What's that process like that's different than when the rest of us are making decisions about
Yeah.
investments or how to spend or how to protect?
Well, it's funny because it comes up all the time, kind of the things we've been talking about, and we're always talking safety first. For
Okay.
instance, we're just on and looking at a very, very large deal. Um, and when we were structuring everything, the issuer that we were working with, we had to educate them about ways that they can put their deal together and structure it to where we can almost eliminate, and they were shocked that we could do this, but almost completely eliminate any downside pressure.
Okay.
And because there's so many people, even in the smart money world, that still have that it's returns, making maximum amounts as possible. And so when we're talking with the family, we're in the meetings, we're like, okay, we've got to the point now where we realize that almost everything we can do, we can minimize, if not completely eliminate the risk in it and still make very good upside returns,
Okay.
outstanding upside returns. And again, most people don't know that. Like even say some of the people on market makers don't even know that because they're
Sure.
so locked into the equity side and producing issues from there. Or issuing from there, I should say. So anyway, I think that's the biggest thing that it always seems to come up in every meeting, and it ends up getting to that. It says, well, if we're going to partner with you, the Hiltons want to know that there is very minimal downside here. What can we do? How can we structure it to make sure that that in fact happens?
Okay. So they're looking from it a more of a defense first
Yes.
before
Yes.
they're, to borrow sports terms, but before they're looking to score, they're looking to stop you from scoring or defend.
Yes. Yeah.
Okay.
And that's a great point. And so what's interesting about it is it does have to be back. We talk about it has to be a mindset.
Sure.
And we just realize that now when we go out into the market and we're trying to make deals, there's some people that don't even want to talk to us because they think that their maximum returns have to stay intact and that's just the way they're going to do it. Sometimes they don't have a long-term mindset. And that no, if we structure the deal and put the investment together or whatever it is that we're working on and put these two other components in it, then yeah, maybe we're going to lop off a few percent per year, but then we're going to have a longer term product to deal with that the
Okay.
clients then are going to stay in more. They're not going to want to bail or jump out
Sure.
because of the volatility associated with it. Uh, and that in itself is just it's a mindset shift. So don't get me wrong. So here's the other thing I'm going to point out too is that you have more of the ability to do that and structure that when you're on the smart money institutional
Right.
side. No doubt about that. Okay. But what's interesting is we've been able to kind of help that flow downstream to more the average or retail investor that doesn't have to have, again, 20, $30 million or something like that. It also works there. And
Okay.
but we had to, and that's one of the things that Brad Hilton and I have worked on. We've had to figure out can we structure that and how can we make that work?
So how have you done that?
So what we basically done is take those high-end products and we've put them more into kind of a retail structure. And we may have talked about this before, Will, but we kind of have a bucket structure where we have
Right.
safe investments, income producing investments, managed money investments, and then the alternative private equity investments. So there's four different buckets. And then we've structured those investments to be able to fall into those buckets and be able to be invested in smaller amounts, that it doesn't have to be a minimum of 5 million or 10 million or something
Okay.
like that, that would have to be for access on the smart money side.
Okay. So
Yeah.
you're taking this beyond the 60/40 that Harry Markowitz has plagued us with when it comes to risk management and looking at, just equities and fixed income.
Yeah, absolutely. Because that type of portfolio is really dead because, putting 60% in stocks and 60% in bonds, there's been 3 years in the last 20 years where both stocks and bonds have gone down
Right.
at the same time. So we definitely want to eliminate that. But you're right. It's the same kind of structure. So people are somewhat used to having having a portion safe and secure, but we're going to use different types of investments, possibly more on the institutional side that are not necessarily just bond related.
Okay.
And then we're going to structure them in a portfolio, and then we're going to still have our investments that help still have a positive returns. But yes, it's going to create that diversification, but in a much more elegant way and a much less volatile way.
Okay. Thank you for tuning into this episode of Wealth on the Move, the podcast, brought to you by Hoffman Wealth Management. Here at Hoffman Wealth Management, we focus on working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while building the life that they desire. And we believe that every financial journey deserves direction. That is exactly what our proprietary process, the HWM navigation formula, provides. Just like a GPS, our navigation formula begins with two key questions. Where are you now? What does your financial picture currently look like? And where do you want to go? What goals and dreams do you have? From there, we help you navigate every financial turn en route to your desired destination with clarity and confidence. It's more than a plan, it's a personalized path forward. If you want to learn more on how the navigation formula can work for you, reach out through the contact options in the show notes below. We would love to help you chart your next move. Now, back to this episode of Wealth on the Move, the podcast. You talk about it in the book, and I want to talk about it a bit deeper when it comes to legacy. It's a topic of conversation in our office all the time. Building, clients wanting to build to pass, passing it most efficiently. When you're sitting with the Hiltons, what's that conversation like? I mean, they're looking not just, we've talked about the long term mindset,
Yeah.
but they're looking generations down the road,
Sure.
and to creating wealth and opportunities for generations beyond just their retirement. Talk a little bit
Mhm.
about what those conversations are like and what folks should be doing in their own households to start planning for this type of legacy.
Well, it kind of circles back to safety. Legacy is safety. So less volatility, safety. So if a key member in the family dies, or a patriarch or whatever, if we've got a less volatile portfolio, we're not, 40% down in our portfolios or down in our entire what we've set up. Also, we're using hedges, we're using
Right.
insurances, life insurance for the different family members to replace money once a real breadwinner or somebody that's really produced for the family passes away. So it tends to, again, goes back to safety, security, setting up really strong estate plans, generally layered trusts, things of that nature, to just make sure that things aren't going to just last 2 or 3 generations, that the money's still going to be there 5 or 6 or 7 generations from now.
Right. Because you hear the stories about the folks that built this country and they're out of money.
Yeah. Yeah.
And you would think it'd be wealth you couldn't spend, and it's disappeared because they didn't have that
Yeah.
mindset that to build, protect, defend.
Sure. We also build in a component of we want the breadwinners, the ones that are bringing money or building the companies, have assets really flowing. We want them to be teaching their children properly that
Okay.
what is wealth? What is it about? So the second, then the third generation, the mistake that um, a lot of the people in our country, at least, the families that built huge, especially during the Industrial Revolution,
Right.
built huge fortunes, is they just taught that first generation,
Hmm.
that second generation technically, and then the second generation did not carry it on to the third. So
Okay.
once the fortune was built, they did not carry those kids maybe became playboys or people that went out and they just spent the
Sure.
money and enjoyed their life and all of that, and they didn't understand that what how true wealth was really built. So it's an education factor also. A big factor of it too is in the Hiltons have the Hilton Foundation that gives away, hundreds of millions into the billions of dollars every year.
Okay.
Um, we also think that that education to the other generations is extremely important
Mhm.
because they realize, like Brad, who is Brad, who is my main partner, who's the grandson of Conrad Hilton. When you talk with him and you converse with him, you understand and get really quick that he is about really doing good in the world and
Yeah.
putting positive things out there. Well, he's gotten that from two previous generations that have taught him that. So they're going to automatically then preserve the wealth because they realize it's doing a much bigger good than just
Right.
giving me my great lifestyle. You know, yeah, these are the kind of conversations that happen in the room with them.
Yeah, because I mean, for a family like the Hiltons, there's huge amount of reputation in addition um, to assets and wealth. That reputation becomes almost as valuable as the portfolio
Sure.
because if they have somebody that's damaging that reputation, makes it much harder to walk into the room if they want to
Yeah.
acquire another building or a hotel or work on that
Sure.
deal. That reputation is just as sensitive as the portfolio. How are they having those conversations? If somebody's listening to that now saying, I've got to really start making sure my kids understand how their decision making at 20 is going to affect their assets when they're 50. How are
Well,
they having that conversation?
yeah, there's a lot of really good books out there that you can steer your kids to. I recommend. I mean, this may be going a little far for some people, and is to understand and first of all to get them and to understand the family history. So lineage, which are the different online, lineage companies that you can go back and once people start learning that too, they learn that there's a little legacy there, even if you're not worth $100 million. I mean, if you're worth a million or 500,000 or whatever, there's still lineage there. And what do we need to do to go on to continue that on? So understanding that, but there's also good books out there on how to do like family retreats where you can talk about money, where you can all openly discuss it. Doesn't mean that you, as a parent or whatever, going to tell them your kids every penny that you have, but
Sure.
start teaching them about, hey, here's how we built our wealth. Here's how we invested. Here's how you need to invest to continue it on for the good of your family and the good of the family overall.
Right.
Those are important conversations to have.
Right. Because I mean, like I said at the beginning or the opening of the show, it's a legacy we would all love to build, and it's the lifestyle that the Hiltons have the capability of having is something that we all are sitting here when we get our first paycheck saying, "I'd love to build this," but understanding the decision making is really where, and the luxury of the decision making, I guess, that the Hiltons have is what
hmm
folks I really think would love to understand and understand how
Sure,
to.
sure, and we do in the book Hilton Wealth: How to Invest Like an American Dynasty. We touched on some of these things. It's a short 100-page book, and it is because no one wants to read a 300 or 400-page book anymore.
Right.
Unfortunately, everybody wants a 1 minute clip on YouTube, right?
Right.
Or Instagram. But we made it short and to touch on some of the basic things. People are welcome to call into us. We can talk to you about some of these strategies. But the really cool thing about it is, and this is why Brad and I have done this with Hilton Tax and Wealth Advisors, is because we want people to really understand from in all levels of wealth really how the wealthiest of the wealthy do it, how to build wealth faster. And even if you start small, guess what? Over time, we talk about that full
Yeah.
circle here in this podcast. Over time, and time is the key.
Yes.
Over time, you can build a very nice portfolio and build a very solid legacy.
Yes.
And you got to start somewhere. Are you the people listening to this? You're going to be the next Hilton? We don't know. Okay. And very, very, very likely it's going to be the Hiltons, the Rockefellers, the Vanderbilt, all that are very, outliers. but you can start small, still build something great over
Yes.
time.
If our
Yeah.
listeners want to follow you, what's the best mechanism to follow? You said you guys are your podcast that's getting ready to take
Yeah.
off. How
Yeah,
do our
podcast.
listeners?
We got started it. I think we've got some good traction, and that is the Hilton True Wealth podcast. You can find that on your wherever you find your podcasts. It's a YouTube channel, and then also you can go to hiltonwealth.com and learn more about us. You can order one of our books. We got a couple books. We got a book on taxes. We got a book on building your wealth in the things that we've talked about today. We'd be happy to send you a complimentary copy of one of those books too.
Awesome. Well, this has been really insightful. Hopefully, folks can learn into the decision making that an American dynasty like the Hilton family, how the benefit of time and the patience of looking beyond this quarter, this year, is one of the biggest assets when it comes to building a legacy that we all desire. You can always check us out on hoffmanwealth.com. I'm very active on LinkedIn. Mark, thank you so much for joining us. This has been a pleasure. Look forward to having you back to extend the conversation at some point.
Absolutely. Well, thank you, Will. It's been a pleasure.
Please remember, like we always say, keep your wealth moving. Thank you. Mark Miller and Hilton Tax and Wealth Advisors are not affiliated with Hoffman Wealth Management and Private Advisor Group. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.